Want to get paid just for holding stocks, even during a market crash? In this video, I'm breaking down the 9 highest dividend-paying stocks in the S&P 500 that could keep your wallet happy even when Wall Street's having a meltdown. If you're chasing passive income, you're going to want to stick around. The number 1 stock will actually shock you. Make sure to hit subscribe and tap that bell so you never miss a chance to build your portfolio smarter and stronger. In 2025, the stock market has flipped the switch. Investors are shifting from growth to income investing. Why? Because in times of uncertainty, dividend stocks offer something rare: consistent cash flow. Starting with UPS with a 6.8% dividend yield. Despite a 22% drop in share price this year, UPS has raised its dividend for 16 straight years. Logistics never go out of style, and neither do steady payouts. Many companies have been struggling lately thanks to the widespread uncertainty around U.S. tariffs, and UPS is not alone. Any decline in broader economic activity, including a drop in consumer spending or business orders, naturally means a downturn in package volume. As a result of this recent pessimism, shares of UPS have slumped roughly 22% year-to-date. However, it's hard to imagine UPS staying down for long due to its dominant position in the logistics industry. From a dividend perspective, UPS just completed its 16th year of consecutive dividend increases, with its current payout after a February bump about 125% larger than 10 years ago. There's definitely risk with UPS given trade dynamics, but a sustainable payout and a history of dividend increases make it worth consideration. AES powers over 2.7 million homes. With a 6.9% yield and a massive energy portfolio, it's not flashy, but it's foundational. AES operates diversified power generation resources across the U.S., including coal, gas, hydro, wind, solar, and biomass facilities. Its total power portfolio can crank out over 32,000 megawatts and distributes power to 2.7 million customers. Like most utilities, AES has an entrenched customer base and a wide moat against competition. Unfortunately, AES has been under pressure in the past few years as its fundamentals have disappointed Wall Street. Most notably, its low margins and questions about long-term profitability trends. To be clear, AES isn't going anywhere given its scale and the demand for its power generation business. And despite lower margins than its peers, its roughly 70-cent annual dividend is only about a third of total earnings and is quite sustainable even if profit growth remains sluggish. A 7% dividend and 56 years of consecutive increases? Altria is the king of high-yield stocks, even when the market's smoking. Tobacco giant Altria has a tremendous history of stability and consistent dividends across even the stormiest stock market environments. The firm has an amazing track record of 56 years of consecutive dividend growth, providing regular paydays that are independent of the broader consumer spending environment, thanks to strong demand for its tobacco products. Unlike some of the other names on this list, Altria is up about 13% year-to-date to post an impressive gain as the market has melted down. That combination of income and growth makes Altria a stock worth watching. Franklin Templeton is a giant in asset management. Despite rough waters, it still raised its dividend in 2024. That's resilience. Franklin Resources is one of the biggest investment banks out there, operating under the global brand Franklin Templeton Investments and commanding about $1.6 trillion in assets under management. The firm had a tough 2024 after a Securities and Exchange Commission investigation into unlawful practices within one of its funds. And just as the dust seemed like it would settle, the volatility brought on by Election Day and the recent trade uncertainty kicked Ben when it was down. Still, the firm's dividend is powering higher after an increase from 31 cents to 32 cents per share in December, so if Franklin Resources can push through its current troubles, then it could be worth buying. With a 7.8% dividend, Pfizer's pipeline issues haven't stopped it from rewarding shareholders. Big pharma, big payouts. Pfizer is a big pharma stock that has lagged behind its peers lately due to troubles with its product pipeline. Most notably, in April, Pfizer announced it would discontinue plans for an anti-obesity drug, leaving it out of the running in a market that some analysts say could be worth $100 billion in a few years. This is hopefully just a short-term setback for a company with roughly 150 years of operational excellence. Furthermore, its generous dividend is quite sustainable, at only about 60% of earnings. So there's little risk of a cut, unlike some of the other firms on this list, where the math doesn't add up. Still, persistent challenges to new product launches could create significant risks to shareholders in the long run. Ford's road has been bumpy, but its dividend game is strong. At 7.8%, it's one of the top blue-chip dividend stocks in autos. A few years ago, Ford looked like it could do no wrong. Wall Street was thrilled by a turnaround effort sparked by a change in the CEO chair, and the company's stock more than doubled in 2021 to trounce the returns of other automakers, including growth darling Tesla Inc. But that success didn't last, and shares are now down more than 50% from their 2022 peak, thanks to troubles with its electric vehicle efforts coupled with chronic recalls over the past few years. What's more, prior headwinds for its China sales have turned into a Category 5 hurricane under President Donald Trump's trade policies. The good news for dividend investors is that a regular 15-cent quarterly dividend supplemented by a special dividend has made F-stock a top income investment. That said, there are real risks to the core business of this auto giant, so the dividends alone aren't enough to guarantee shareholders will have an easy road ahead in 2025. 9.2% yield. But warning, it's been cut before, this one's for the brave. Down 34% in the past year and roughly 80% from its 2022 highs, WBA has been one of the worst S&P 500 stocks of the past few years. In 2024, the firm cut its dividend from 48 cents to 25 cents per share. Because annual payouts are expressed as a percentage of current share prices, the flop in WBA stock makes its smaller dividend still big by this measure, but it's a decidedly bad sign if dividends and shares are in freefall, as they have been for Walgreens lately. Time will tell whether the company's broader plans for a corporate turnaround pay off. So, any investors interested in a yield that is almost 6 times the average of the S&P 500 need to remember the recent declines and dividend cut as an indication of what could come. At 9.4%, LYB is all about petrochemical power and long-term customer contracts. High risk, high reward. LyondellBasell is a petrochemical company that is one of the world's largest producers of plastics and resins. The good news for LIB investors is that its specialized business is hard for new entrants to compete with, and many loyal customers have long-term relationships with the firm. The bad news, however, is that a materials stock like LyondellBasell can be sensitive to industrial demand, and Trump's recent trade turmoil has resulted in a ton of uncertainty for LIB's customers and challenges to the firm's operations. LyondellBasell's annualized dividend is slightly higher than its projected earnings for this year, but profits are predicted to pick up in fiscal year 2026. It's an open question just what the future holds, but for now, this chemicals leader pays a big dividend. Dow tops the list with a 10% dividend yield, but when dividends outpace earnings, danger might be closer than it appears. Materials giant Dow is intimately tied to the history of the largest chemical firms on the planet. As with LyondellBasell, the recent economic turmoil has weighed significantly on its business, and unfortunately for investors, there's not a lot of history to see how the company fares in a downturn. That's because Dow and the predecessor of DuPont de Nemours Inc., DD, merged to form DowDuPont, a short-lived enterprise that eventually split again into 3 companies, the current DOW and DD stocks, along with agricultural chemicals firm Corteva Inc., CTVA. The history is a bit complex, but its recently declared 70-cent quarterly dividend is the same as the first payment since its 2019 separation from DowDuPont. Unfortunately, earnings per share have shrunk far below what Dow pays in dividends, so investors have punished the stock lately. Specifically, the share price is about half what it was a year ago. A dividend cut is a real possibility, but for now, Dow ranks as a top S&P 500 dividend stock. Remember, high dividend yield doesn't always mean high safety. Sometimes a sky-high yield is just a warning sign. Do your research, stay diversified, and focus on sustainability. Drop a comment and let me know which of these dividend beasts is on your watch list. And hey, if you want more content like this, give this video a thumbs up so I know you're into it. This is the Piggy Bank Chronicles, where we turn cents into cents. Keep stacking, keep learning, and I'll catch you in the next one.